All right, let's peel back the layers on something everyone is talking about, AI. It's absolutely everywhere, right? From those clever new apps on our phones to the complex systems powering major industries behind the scenes, the buzz is undeniable, and the advancements are genuinely breathtaking.
They really are.
But what if much of this incredible glittering boom is built on foundations that are, well, maybe a little less solid than they appear?
It's a critical question, and what's truly fascinating here is the sheer speed at which capital has flooded into the AI space. I mean, almost picking a winner overnight.
Right.
Today, we're going to dive deep into a crucial analysis, notably from Ollie's AI Dispatch in the Fragile Future of AI, Beyond Venture Capital Subsidies, along with other compelling reports. Our mission is really to cut through the relentless hype, understand the surprising, sometimes counterintuitive economics beneath the surface, and explore what a truly sustainable future for AI might look like for you.
For you, whether you're building with it, investing in it, or, just navigating a world being reshaped by it.
Exactly.
We're not just going to throw numbers at you. We'll look at the astounding figures, yes, but maybe more importantly, the real-world implications and what history might tell us about such rapid, concentrated growth. Get ready for some genuine aha moments that I think will fundamentally reshape how you think about AI's trajectory. Is its glittering facade hiding an ounce of cards? Let's find out. What really struck me when I started looking at the numbers was just the sheer scale of investment in AI right now. It's enough to make your head spin. Do you know how much money AI startups have pulled in just in the first half of this year, 2025? It's over $83 billion.
83 billion. Wow.
And that's not just a big number in isolation. It represents nearly 58% of all venture funding. Think about that for a moment.
Yeah.
Almost 60 cents of every venture dollar went to one single sector. And in Q2 2025 alone, AI soaked up approximately $50 billion of the total $101.5 billion in funding.
50 billion in one quarter.
While non-AI funding actually fell to a 7-year low, this isn't just investment. It feels like hyper-concentration.
It really is. And to put that in perspective, it's not just the colossal amount, but how intensely concentrated it truly is. By mid-2025, we're looking at over 500 AI unicorns.
500.
Yeah, those privately held companies valued over $1 billion with an average valuation of, $5.4 billion each? Average. And what's particularly striking and frankly a bit unsettling is that many of these companies are quite young and incredibly pre-revenue.
So pre-revenue.
Meaning they haven't actually launched products or generated sales yet. This isn't a broad market boom. It's like a handful of massive bets.
Right.
Just look at the mega checks telling the story.
Yeah.
OpenAI, for instance, raised a staggering $40 billion in early 2025. SoftBank-led round. That set a new private tech record.
40 billion.
Then Meta bought roughly 49% of Scale AI for $14.3 billion. And if you zero in on Q2 2025, over 1/3 of all global AI venture funding went to Scale AI alone.
One company.
One company. That's not just concentration. It's like a financial vortex where capital just rushes into very few players.
And it gets even wilder, doesn't it? Some of this investment isn't even tied to existing products or like even a clear path to revenue. It just feels like pure speculation. Thinking Machines Lab, for example, raised an eye-watering $2 billion seed round at a $12 billion valuation with no product.
No product.
Similarly, Save Superintelligence managed to pull in $2 billion at a $32 billion valuation, also with no revenue. I mean, how do you even begin to justify that kind of valuation?
It's difficult. And Sam Altman himself, the CEO of OpenAI, he candidly called much of this not rational.
Yeah, I saw that quote.
Predicting quite bluntly that someone is going to lose a phenomenal amount of money.
You have to think so, right?
Which raises an important question for all of us. Are we seeing an AI bubble forming here?
The B word.
The B word. The context here is absolutely critical. The tech sector now makes up around 34% of the S&P 500. That actually exceeds the peak we saw during the infamous 2000 dot-com bubble.
Higher than 2000, okay.
Higher than 2000. And financial experts like Apollo's Torsten Slok suggest that today's leaders are even more unrealistically valued than those dot-com darlings were. With AI multiples currently sitting above the 2000 peak, meaning investors are paying an even higher price for each dollar of potential future earnings.
So the dot-com comparison isn't just, hyperbole. It's a serious point of analysis.
Absolutely.
But at the dot-com era, for all its irrational exuberance, it did eventually give us giants like Google and Amazon. enduring companies.
That's true.
Some argue AI's fundamental utility is far broader and deeper than the Internet's early applications. Is that a distinction without a difference, or does it offer a glimmer of hope that this isn't just a direct replay?
That's the key debate, isn't it?
Because when we talk about all this money flowing in, what does it actually mean for profits? I mean, the uncomfortable truth seems to be that the intense hype often isn't translating into measurable returns for businesses.
Not yet, anyway.
A 2025 MIT analysis found something shocking. 95% of corporate AI projects delivered no measurable profit.
95%.
Firms collectively spent approximately $40 billion on pilots that just missed their goals. I've seen this firsthand in the real world. I remember a project the AI model was brilliant in the lab, predicted outcomes with 99% accuracy, dazzling demo. But getting it past our legal team on data privacy, then getting the operational team to actually trust it over their gut feel,
Right.
or just integrating it into legacy systems, that's where it stalled.
Yeah, the last mile.
The human element, the data quality, the change management, they're often the hardest parts. So, put simply, for every dollar being invested, very little seems to be turning into actual measurable profit.
And building on that point, what's fascinating is how much of the spending acts like a massive private sector stimulus, as one economist put it.
Stimulus.
Yeah. Paul Kudrowski observed that AI spend is responsible for an estimated 40% of recent U.S. GDP growth, yet he states it has yet to actually make anyone any money in net profits.
40% of growth, but no net profit. It's quite a statement.
It is. So what does this imply for you listening? It means that capital expenditure, headcount, cloud bills, they're all significantly up, pushing economic activity.
Right.
But sustainable profit margins, they're just not following suit for most. This kind of fundamental imbalance, where costs are just way out ahead of revenue generation, it simply can't run forever without some kind of correction.
We've also seen some really high-profile failures in consumer-facing AI products recently. Stark reminders that good intentions, and even massive funding, don't always cut it in the market.
Definitely.
Take Forward Care Pods. Burned through $650 million before shutting down in 2024.
Ouch.
Then there's the Humane AI PIN, launched at $699. Remember the hype? Only to see returns outpace sales. It basically disappeared by early 2025.
Yeah, that one fizzled fast.
And in autonomous driving, too simple. The trucking company slid from an $8 billion valuation down to less than $300 million. Losses, regulatory pain. It really shows that even with massive investment, basic market realities still apply.
They do. And the market isn't always kind to innovation that isn't quite ready, but it's crucial to acknowledge there is real value being created. We shouldn't dismiss the entire movement.
Okay, fair point.
Nvidia's revenue, for instance, is up 262% year over year. That's driven by genuine demand for their accelerators, the chips powering this AI boom.
So the hardware guys are doing well.
Extremely well.
Yeah.
And select enterprise workflows are reporting significant improvements, in the range of 30–50% efficiency gains in some cases.
Okay, so it's not all hype.
No, but here's the caveat, and it's an important one. These gains are often narrow and uneven, and the costs involved for top talent, building robust data pipelines, rigorous evaluation, governance, safety, these are stubbornly real and remain incredibly significant.
Right.
So while the picks and shovels players like Nvidia are thriving, which shows real demand for the core infrastructure, that doesn't necessarily make the entire ecosystem healthy, just maybe the very bottom layer of the stack.
So let's unpack this then.
Yeah.
Why does AI seem so pervasive and, in some cases, surprisingly affordable to the end user if the costs are so high?
Yeah, it comes down to this hidden financial reality, what some are calling the subsidy treadmill.
Subsidy treadmill.
Imagine this chain, it helps illustrate it. A user pays, say, $200 a year for an AI app.
Okay.
But that app's underlying foundation model, maybe from a company like OpenAI, costs the startup roughly $500 to use. That's a $300 loss right there per user per year.
Okay, losing money on each user.
Then OpenAI pays Microsoft for the compute power needed to run that model, probably incurring a loss there too, given the immense scale. And Microsoft, in turn, shells out maybe something like $5,000 to Nvidia for the necessary GPUs, also likely at a loss on that specific transaction layer.
So losses all the way down.
Potentially at each layer for that specific interaction. The key insight here is that at each step of this chain, venture capital is plugging the gap, making up the difference between what's charged and what it actually costs to operate.
Okay. So the VCs are footing the bill.
Essentially. This creates the illusion that AI is cheap and abundant, but it's largely propped up by billions in investor subsidies. You're essentially getting AI at a discount.
But someone eventually has to pay the full price.
Exactly. And if we connect this to the bigger picture, you'll immediately understand why major AI players are experiencing these massive losses. OpenAI reportedly lost $540 million back in 2022,
$500 million.
running ChatGPT, estimated to cost around $700,000 per day, just for servers and power.
Per day. Wow.
Per day. And Alphabet's John Hennessy even admitted that a single Bard query costs 10 times more than a standard Google search.
10 times more expensive per query. That's not sustainable at Google scale.
Not without a different model. The staggering burn rate also explains why Sam Altman has openly floated raising another $100 billion
Another $100 billion.
to pursue artificial general intelligence, AGI, which is essentially human-level or superhuman AI. He described OpenAI as the most capital-intensive startup in Silicon Valley history.
I believe it. So what's driving this relentless pursuit of capital, this scale of spending? It's the technical strategy itself, right? More is more.
Largely, yes.
Yeah.
The idea has been bigger models, more data, more compute equals better AI. And to be fair, this approach has delivered stunning breakthroughs. We can't deny that.
Sure.
However, the challenge that diminishing returns seem to be setting in already. Each new increment of scale yields smaller and smaller gains in performance,
Right. You hit a wall.
while simultaneously hitting harder constraints like GPU shortages, absolutely massive energy consumption, and soaring cooling costs for these huge data centers. It's a very expensive race, and the rewards for each additional dollar spent are shrinking.
So who ultimately pays for this escalating arms race?
Well, that's the crucial question. Big tech, which already spends more on AI infrastructure and R&D than all venture capital combined, they've responded to these pressures by lobbying for public subsidies.
Government help.
Exactly. In the US, AI is now framed as a national strategic priority. So you see government grants and state-level incentives flowing into hyperscale data centers.
Okay.
The concern here, for you and for society, is that this risks making AI too big to fail. A system where the immense costs are effectively socialized, borne by the public.
But future profits remain privatized and concentrated in just a few hands.
Precisely. It's a classic moral hazard potentially in the making.
So what does this all mean for the future? I mean, if this truly is a bubble, or at least the highly subsidized phase, what might come next? History seems like the place to look, right? The dot-com era.
It's the most obvious parallel. Back then, around 4,800 of approximately 7,000 internet startups failed by 2003. A massive shakeout.
Wow, huge failure rate.
Huge. Yet the internet itself survived and matured. Companies like Google and Amazon ultimately won, not just through hype, but through real technology and, importantly, disciplined business models.
Right, they figured out how to make money.
Exactly. It suggests that a shakeout doesn't mean the end of the technology itself, but rather the maturation of the industry. So what signals are we seeing today that might point to an inevitable correction?
Yeah, what are the warning signs now?
Well, the signals are starting to become clearer. We're already observing deal volumes cooling off a bit.
Okay.
Investors are starting to steer away from those vague AGI promises, moving instead toward enterprise value and concrete infrastructure plays, things you can actually bill for.
Makes sense.
The persistent IPO drought, the lack of big exits, that's also pushing VCs to demand actual revenue, or, failing that, to pull back their funding altogether. The pressure is mounting.
So what are the likely outcomes if a correction happens?
We can probably expect a shakeout of the weaker players and what's been called pitch deck theater, fancy presentations hiding a lack of substance.
Yeah, see those.
There will likely be consolidation around the cash-rich platforms and maybe a few truly durable independent companies. Investor discipline will return with a vengeance. Revenue, margins, unit economics, they'll matter again.
Back to basics.
Back to business basics. And crucially, we'll likely see a significant shift from the bigger's better mindset to a focus on efficiency, domain-specific models, and robust systems engineering.
Okay, efficiency instead of just size.
And this will probably also entail a heavier public and academic role in funding fundamental research and ensuring safety standards are met.
That shift from bigger is better to efficiency sounds really impactful. What does that specifically mean for building AI and for companies looking to adopt it?
Yeah, that's a great question. The bigger is better arms race for these ever larger general purpose models. While it yielded amazing breakthroughs, it just isn't sustainable long term from a cost perspective for most applications.
Right.
Instead, we'll see a move towards right-sized models. This means developing smaller, more specialized models.
Tailored to specific tasks.
Exactly. And when you pair these with retrieval systems, which allow them to pull in relevant information just when needed, and some clever prompt engineering, these smaller models can often outperform the massive general-purpose LMs on cost-adjusted utility.
So better bang for your buck, basically.
Precisely. You get better performance for specific tasks at a fraction of the cost, which is absolutely crucial for demonstrating real ROI.
And how does human in the loop by design fit into that more pragmatic future?
That's key. In this more sustainable future, AI needs to augment humans, not just aim to replace them wholesale, especially in safety-critical areas like healthcare, finance, law.
Places where mistakes are costly.
Very costly. It means designing AI systems where human oversight, judgment, and intervention are built in from the ground up by design. This builds trust, it reduces liability, and frankly, it leverages the unique strengths of both humans and AI.
Makes sense. So for people listening in a professional role, what does this mean day to day?
It means getting serious about evaluation harnesses, setting up guardrails, having observability into how your AI systems are performing, tracking cost telemetry, and maybe most importantly, directly linking AI projects to measurable business KPIs. It's really about pragmatism and accountability.
Okay, so how does this potential correction and shift impact you listening in the workforce, especially for those working with data or in tech fields? The wave of AI is already changing jobs. I mean, the author mentions their own role changing.
Absolutely. Automated machine learning, auto ML AI, building AI. Essentially, it's handling a lot of the baseline modeling now. Large language models are drafting SQL queries, writing code, creating tests, documentation, even drafting incident reports. Work that once required a deep specialist is becoming accessible to a power user who knows how to craft the right prompts.
So the tools are getting more powerful.
Definitely. In fact, estimates suggest around 75% of developers are already using AI assistants in some capacity. Their work is shifting from just writing code to reviewing it, specifying requirements better, and integrating these AI tools effectively.
That's a big shift.
It is. And the World Economic Forum points out something really interesting here. Data-rich white-collar tasks are actually more automatable in many ways than manual jobs.
Because the training data is cleaner, more available.
Exactly. There's just so much digital data for them to learn from.
So what do the macro estimates say? Are we talking massive job losses?
Well, the estimates suggest around 300 million jobs globally could be exposed to automation at the task level.
Exposed to the task level, okay, that's an important distinction. Not necessarily whole jobs disappearing.
Right. It means tasks within jobs might be automated. We'll see task shedding, roles being redesigned, but also new jobs emerging in areas like AI evaluation, safety, model orchestration, governance.
Human oversight roles.
Precisely. The key insight, as the author puts it, is powerful and something to remember. AI won't replace data scientists, but data scientists using AI will replace those who don't.
Adapt or get left behind, essentially.
It's about adaptation and integrating these powerful tools into your workflow, whatever your field.
Okay, so looking at the bigger picture again, moving beyond these VC subsidies means moving beyond the inevitability narrative, the hype, towards a truly sustainable path for AI. What does that path look like?
It involves several key shifts: building sturdier foundations beyond the real ROI we discussed, and right-sized models.
Right.
We also need to see monetization that matches cost. The idea of AI everywhere for free, funded by VC hope, that's a myth. Expect more realistic pricing, enterprise subscriptions, licensing, usage-based fees.
Pay for what you use.
Basically. Also critical will be regulation that stabilizes. Sensible rules around data provenance, evaluation protocols, incident reporting, transparency. These will weed out reckless players and build consumer trust.
Build confidence in the tech.
Exactly. And finally, diversified funding sources. Beyond just VC, we need public research grants, thriving open source ecosystems, cooperative funding models, maybe state-level incentives, spreading the risk and fostering a healthier, more diverse environment.
So summing this all up, where does this leave us? AI's present is spectacular, truly groundbreaking, but it's also undeniably fragile.
That seems fair. Financially fragile because of that subsidy-driven burn rate we talked about. Technically fragile maybe because of diminishing returns and physical limits starting to bite. And socially fragile because trust can quickly whiplash if things go wrong.
But fragile isn't doomed, right? Like the internet example?
Exactly. Fragile isn't doomed. Like the internet after the dot-com bust, we can reasonably expect AI to follow a similar path. Likely a correction, then a consolidation around the stronger players,
Hmm.
and then probably a quieter era where AI matures into more of an everyday utility, integrated seamlessly, almost invisibly, into the fabric of our lives. It won't be as flashy, perhaps, but it will be more fundamental.
How we navigate this next phase seems absolutely crucial then. Managed well, we could gain this resilient general purpose capability that quietly upgrades everything: healthcare, logistics, education, environmental monitoring, you name it.
Huge potential upside.
But mismanaged.
Yeah.
We risk a really sharp correction, widespread distrust, and significantly slower innovation. That could set back progress for years.
The stakes are high.
The author concludes that AI is too important to leave to venture capital alone, which really makes you think. So, for everyone listening, what role do you think individuals, businesses, governments should play in ensuring AI builds a future based on real value and trust rather than just hype and subsidies? What's your next step in understanding and shaping this future?